Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
There's a lot of moving parts from this that people are not understanding. Well, you have this gamma squeeze where people buy calls and then the dealer needs to hedge off the risk, and then that basically causes a reflexive dynamic of forcing the stock up. And then from a pure Delta One perspective, I mean, it's a short squeeze, right? These are distressed names. GME, AMC, BB, all distressed plays where people are piling in hundreds of millions of dollars shorts on these things.
All right. Hello, everybody. Welcome to another one of our WTF episodes. My mom would be so proud. I just can't bring myself to use the actual F word. But we like to spin these up with only a day's notice or so to our guests when there's something happening in the markets that really does make you think the world is insane, like crude oil going negative. And this week, it's a relatively obscure stock, GameStop, gaining thousands of percent, and the mother of all short squeezes, gamma hedge-fueled rallies. It's dominating traders' feeds all week, and we grabbed two of the best peeps we know to talk market maker dynamics and flow. Kris Sidial of Ambrose Group and Cem Karsan of Agea Capital. Is it Cap, Cem?
Capital.
Agea Capital, sorry. So we brought these guys on to answer what the actual F is going on. So welcome, guys.
Thank you for having me.
Thanks for having us.
Yeah. So, Kris, wanted to start with you. You mentioned about 150 points ago in GameStop that there was more coming to this short squeeze. Tell us what you're seeing and how it played out, whether you played out as you thought it would or way different.
Yeah, so I know I had tweeted that when GameStop was at like 45 or whatnot. More so because you see these dynamics happen much more frequently than people understand. And this happens all the time in markets in so many different asset classes, like just like crude oil, right? People underestimate the potential distribution of outcomes when we are at levels of extremity, right? So people say, oh, this now goes 2 sigma. There is no way this can go, 4 sigma. So what does it do? It causes people to pile in, right? Like, for example, if a stock goes 200%, people pile in short and they say, oh, it has to go down. Reflexively, now it makes it go 600%, right? So this dynamic is a constant theme in markets. And I think, with the Citron news coming out, it just had a bunch of more people piling short. And when I was seeing it, I was looking at some of the price action and I was saying to myself, well, this is looking like it's just grinding up. People are consistently buying it and everybody's short and more people are piling in short. And I looked at it and I was like, yeah, I could see which way, this is going to go.
And what was the Citron news? They came out with a report basically saying this thing's toast.
Yeah, exactly.
And that was only like a week ago.
Right. And now GameStop's trading at $350.
Right. But in that, to me, well, just getting that note. So to me, and there's these guys who've made millions of dollars, right? But they're buying $50,000 worth of a out of the money call that has to move 100% in a week, right? That's the insanity to me of all props to those guys. They've done well, but it's kind of an insane trade, right?
Yeah, it's a real risky trade. But again, I think there's a lot of moving parts from this that people are not understanding. Well, you have this gamma squeeze where people buy calls and then the dealer needs to hedge off the risk, and then that basically causes a reflexive dynamic of forcing the stock up. And then from a pure Delta One perspective, I mean, it's a short squeeze, right? These are distressed names. GME, AMC, BB, all distressed plays where people are piling in hundreds of millions of dollars shorts on these things, right? And when you have that and you have that dynamic of well, here comes a gamma squeeze, here comes a single stock squeeze. And then, which is the most interesting part about this whole thing, is the predatory type of institutional ability to take advantage of these things. It creates something that's really big like this. People think that this is all Wall Street bets. It's not.
Yeah.
I'm looking, at some of the flow coming in, especially on level 2. We have access to some of the level 3 stuff as well, and you see it. It's like, this is not only Wall Street bets. Prop guys know what they're doing. Certain other hedge fund guys know what they're doing. They're bringing things up to certain levels, and it's causing this.
Let's circle back to that, and I would bring it to you, Cem, and say, right, from a former market maker standpoint, like, what do you think this has looked like for them? Are they, going home and popping a bottle of champagne, or are they quaking in their boots?
Yeah, Kris used the word predatory. I'd be a little more cautious with it. The reality is Citadel, which is now over 25% of market making volume. Yes, if they see weakness, right, they understand dealer positioning, right, and how important that is for market direction. So that goes into their models. They'd be foolish not to. That's what the market's, driven by to a great extent. But they're really playing the flows, in my opinion. They see these things coming. They don't want to be run over. Not only is it bad for business, it's more profitable to get ahead of it. And so they see the flows coming. They're consistent. They're reliable. They're predictable. And so they're jumping in front of them and front running them and buying it, and then selling it as it gets bought. And this creates a cascade, right?
So hold on, you're talking about them as a market maker or as a hedge fund?
Both, right? As a market maker. But the reality is, as a market maker, you're going to position yourself for incoming flows. If you have consistent buying of vol day after day, I'll tell you, in 2008, 2009, you didn't come in short vol. You made sure you were long vol every day, because you knew each day you'd come in and there'd be some crazy bid to vol somewhere that you'd want to sell. And the second you sold it, you'd get long again, right?
Right. So the simplistic example is
yourself to get ahead of the coming flow. You have to, because you have to be absorbing that leverage, right? Absorbing that flow. And so, that's, you can say as a market maker, hedge fund, it's a very gray line, right? It's kind of like when banks used to market make, and they had to kind of divest themselves of that, or they could market make it, they couldn't have the positions. They still end up having the positions because they were market making. So yeah, in my opinion, there is some of this, hey, people see blood in the streets, they know where the pain points are and they push on it. But the line of whether that's predatory or really just investing nowadays, we talked about dealer positioning and how critical it is. This world is not a world based on fundamentals at these liquidity levels. We're how available money is and how easy it is for people to invest. It's about, it's about where the flows are going. Companies aren't going bankrupt because there's infinite liquidity. So at the end of the day, who's buying, who's selling? If people are more buyers than sellers, you better be buying that name. It's not a function of fundamentals. Like Kris mentioned, if you're somebody out there playing the fundamental games, it actually ends up being a disadvantage to you, because you're betting on something that has nothing to do with the reality of where these prices are going. And ultimately, you end up getting short and being somebody who, is playing the wrong game.
Right. Sorry,
real quick. Just can you explain the difference between a dealer and a market maker, if there is one, or you're just using those interchangeably?
Dealer is a broad term for anybody who takes it for the street. So anybody who's taken the other side of customer flow. So it could be market makers, it could be banks, it could be other entities warehousing risk. But it's essentially where the customer flow gets warehoused.
Right. So different than the pure market maker who's just making a market on that option and might have to gamma hedge. So the dealer may have inventory they're trying to offload or something like that.
Right. The dealers generally hedge, right? So because they're taking and warehousing risk and trying to manage it, factor neutral.
Right. And it's an interesting point though you're making, because the simplistic example that we put out on our blog and a lot of nice work out there is right of, hey, retail's buying these calls. It's a 20 delta. The dealer has to buy, 20 deltas to hedge themselves out. Gets closer to the strike. Now they have to buy 80. Now they're 90. Now they're 100. But you're saying it's even more complex than that, because they know that's coming. So they might have to pre-position themselves and They're not waiting for the call option to come in. They're actually going to buy those deltas before it comes in.
This isn't a world where you blindly just say, make a market and then take it and you hedge it and move on. You have a factor model, you're looking at the whole market, right? And you're not just hedging it with underlying delta, you're doing it on a correlation basis, on a dispersion basis. The best market makers have, real-time models with every single factor flowing in, and every factor on that factor, vol factor, skew, ptosis, et cetera. And so at the end of the day, as one's moving and you're getting too much inventory in that way, you have to move your model, right? To take back aggressively what you're getting short, which means ultimately you end up being the most aggressive buyer out there and pushing along with it because you don't want to be the one caught short. So there is that process. And obviously the more reliable the flow is, the more it's coming, the more predictable it is, the more aggressive you're going to be to make sure that you kind of get taken out of it. And so, Citadel's making a lot of money on this, not just because of the market making, because I'm sure they're going with the flow. But that's what they do. It's not predatory. It's really what trading is nowadays. If you don't watch the flow, if you don't know where things are going, it's a liquidity-driven world. It's not a world where this is cheap and that's expensive based on fundamentals. It just doesn't. Things don't move that way.
And Kris, I cut you off. Sorry, what were you saying before?
Yeah, I agree with Cem. So I want to stand on this point that I think that what these guys are doing as traders is not predatory, right? But most people will look at it as it's a predatory action, right? I was on a prop desk. I know what it was like to trade prop, right? Guys have certain things that they look at on a day-to-day basis where they say, where are people positioned at, right? And they have certain ways to understand the way how flow is coming in, right? And levels where everybody else is looking at. So when I say a predatory way, right? Institutional guys know what they're doing when they're buying at certain levels and selling at certain levels. They're moving, right, the actual underlying for a particular reason. And this is not just prop, right? So I don't want to single out all the prop guys. These are hedge fund guys as well. I have guys who are also buy-side Delta One traders, and I know they know what they're doing in these things, right? And what I was saying before is that the actual flow is showing me, right? The flow that we are seeing and we are noticing, it's very obvious to see. This is not Wall Street bets, right? Like I was looking at the price action on BB, right? We're tracking flow there. We're seeing level 2, some of the prints coming through a level 3. And it's very clear that, once this thing breaks through a specific level, it starts skipping up, a buck every 30 seconds. The reason for it, right, is because guys knew if they ticked it up to that level, it's going to move a specific way. And then also, we track intraday correlations. So, all three of these names, BB, AMC, GME, non-correlated. But if you look at some of the intraday correlations, they trade in line. At 5 a.m. this morning, I was looking at how some of these things were moving, right? GME would drop down a little bit. Then you would see the best bid on AMC drop, the best bid on BB drop. This is not a Wall Street bet guy that's in front of his screen saying, oh yeah, GME's down. I'm going to, I'm going to bid a little lower. Right. This is an algo that's coming from one of the guys that's trading it the same way that I was explaining. So I agree with Cem when he says, it's not predatory. Maybe I use that term in the wrong way. But when I say it, I mean, guys know what they're doing. Right. This is not just those Wall Street bet kids that are playing this. There are other smart investors, smart traders who also understand this location.
Sharks.
Right. Exactly.
Yeah, they're alpha predators. Yeah, you're right. I mean, it is predation in the sense that the markets are a series of the hunted and the hunter and the hunted. So I agree with that. I think I was more reacting to.
No, I completely get it. Because especially right now when you have this thing going on with everybody saying, well, is it wrong that some of these Wall Street bet guys, are they partaking in price manipulation? I don't think so. I really don't. This is a market, right? If I wanted to buy Apple from you at $1,000, who's to say that that's the wrong price, right? What's the reason that's the wrong price?
Yeah, no, I think there's, this is a whole nother debate. I don't know if we want to get down this. This is a series of grays, right? Once you get into this world, and I'm not going to die on either side of that hill. The reality is there is a line, and I think we can all agree there is a line where at some point there's coordinated action, right? And it's if you had a bunch of big hedge funds teaming up together to kind of take down another fund, right? Knowing their positions, that would be illegal. That would be predatory, right? And so
Right.
there's a lot. Yes, this is how markets work. At what point is it, explicit, and kind of the intent is to, to team up and to do something that is not free market.
Right. Do you think we'll get any senators who will go fight for Wallstreet on, against the retail guys?
Right. I mean, this is the thing. This is the reason I don't think the SEC is going to come out and say anything soon, is because they're, if, unless they do some blanket statement across, hedge funds, everything, because there is this sentiment that, hey, nothing's been done about this for years when the big boys do it. Why are they saying something now that retail is doing? Yeah. I think that it'll feed into this whole inequality narrative and kind of be a mess.
And there was an interesting Dave Nadig, I don't know how to say his name, Nadig, had a great post of like, this isn't about the gamma. It's not about all that. It's social media and the algorithms they're using to serve up what you click on most. So it's almost like the gamma trade inside the social media, right? Of the more people click on GameStop, the more content about GameStop they're going to get. And it just creates all of a sudden a herd mentality just based on that social algorithm of, on TikTok, on Reddit, on all that, it gets voted up and you're going to get more of that content and it's going to drive more people to buy the calls and it's going to drive the price. So there's a little bit, it's different this time, is his argument, because of this social algorithm piece. So you guys got any thoughts on that?
Yeah, I think that's part of it. I don't think that's my personal opinion is that's not the core going on. I think this was happening, something very similar, but without derivatives, right? In 2000, I mean, you had chat boards and people, up and they were pushing, they were squeezing shorts and
when bandit rooms, right?
Yeah, so I think the leverage is different. I think that's the big difference. The adoption and ease of trading options, call options in particular, and the gamma and leverage that's embedded in that. You've basically taken, retail and given them a 10x multiplier. And so that's incredibly powerful, not just because of the leverage, but because of the profitability that comes with that. And then the added leverage that gets added, it's an exponential function, right? So I think that's what's really different. They're a lot more powerful this time because they have a cool new weapon.
And I think Ben Eifert had a nice graphic explaining that of like $1,500 premium in Amazon in his example resulted in a market maker, a dealer buying 230,000 worth of stock, as at the
end of the day, there guys, you've seen the posts, 10K in and now they're writing a $20 million check. I mean, and they're doing that quickly because of leverage, and that 20 million is now leveraged again, right? And there's nothing that says that can't become 200 million. It's just, that's the crazy game of leverage. And but at the core of it, I think that the thing, we shouldn't lose sight of is what Kris, said at the very beginning, that this is about positioning, right? There are guys out there with that it became public what their positioning was. And that positioning is in these markets, which is all liquidity based, is ultimately something that will lead markets to go there. I mean, this is, I've talked about it as, I call it Gary or whatever, right? The dealer positioning is ultimately what is driving the supply and demand dynamics, and particularly in derivatives, which has this embedded leverage in it and really has gotten so big that it's kind of dominating flows.
But even in this case, it wasn't necessarily the dealer positioning, right? But the Melvin Capital, the short sellers, like, you don't know all the flow trading you guys do. You don't know when that short seller has to puke out, right? Like, that's the missing piece in terms of.
Well, you could see that though, like you could, when the price action starts to react a certain way, when somebody's just basically puking it all out, right? Like levels start to skip tremendously high, right? The market winds up at a certain point. You could spot that. I think if you're an experienced flow trader and you know what to look for, when something is abnormal at that price level and with that price action.
But it's in real time after the fact, right? You can't see it like flow. You can kind of tell before the fact or have a guess of where the levels are, where the hedging needs to take place.
Yeah, well, while it's taking place, something's abnormal. You may not know directly, oh, that's, Melvin Capital or whatever, but something abnormal is taking place. This could be, a specific fund, or, somebody's coming through a specific route consistently, right? They're coming through that route with the same type of lot, maybe like 1,000 lot, 2,000 lot, hits the route on VWAP, every time it goes to VWAP. So you pick up on things like that, and okay, that's a big order there. Somebody's consistently bidding or offering at this level. So it's little things like that, when it's abnormal. But it's interesting too, because everybody focuses on, everybody's talking about this Melvin Capital thing. These are all distressed names. You know how many other funds are underwater? Everybody's just been piling in short on this. Like
there was another one that came out just before we got on. I'll pull up the name, but yeah,
like
can't be just them, right?
Right. No, it's not just them. I honestly feel bad for the guy because he's being singled out on this whole thing, and it's like you're gonna start hearing more names pop up. I even tweeted about this last night. Like just AMC alone, you're gonna see AMC squeeze today, and anybody could have told you it was gonna squeeze because. Again, if you have a bunch of funds that are short distressed names and then they just gap up 100, 200%, you have of course you're going to get, forced liquidation.
I think this is an important point. And I think, we're recording this right after that big drop today, right? That's completely tied to what's going on as much as people don't. If you've been watching the action, you understand what's happening. Hedge funds are having to liquidate their long side of the pair trade, and a lot of these guys have been short all of this, junk, right? And they've been long stuff that they believed that had, was a good hedge against it. And again, in a world that's all liquidity driven, has nothing to do with fundamentals. Now all those longs have to get liquidated to make room on the sheets for the liquidation of the shorts.
And those are, we're basically saying margin calls or just to keep their risk in balance or both? Yeah.
Both. First margin calls, right? But then you can't continue to stay long that stuff if you're getting killed on the other side. Plus, if you get redemptions, right? Somebody comes in and says, hey, you're down 30%. I want my $5 billion back, right? You got to liquidate both sides of the book. It's whether it's a margin call, redemption, whatever it is, that long's got to go too. And so, what you're seeing today is a result of serious pain on a lot of these names. And it's going to, until this is resolved, I think you'll see a little bit more of it.
No, you're 100% right. Sorry to cut you off, Jeff. That is 100% right. That is exactly why we noticed the relative weakness in the market today as well. And you notice people are going to do this on the large, thick names, right? You're not going to do this on a small cap name or a mid cap name, right? If you're exiting a position, you're going to want to do it on a name like Apple or Facebook or Tesla. You will have relative weakness in the larger names because you could enter and exit at better or worse prices that won't be much more detrimental than if you were in like a small cap type of name.
Right, and even let's just talk. We're talking GameStop is mall-based video game sales, right? It, basically the most antiquated business you could come up with right now, right? Like it's all subscription based and goes online. AMC, movie theaters. Who's going to movie theaters right now? And what BB is Blackberry?
Yeah.
Right. Like who do you know with a Blackberry? Right. So like fundamentally, like you're saying, like these are the three stocks you would least want to own in the universe. And they're up hundreds of percent. And if I'm a dispersion trader or a pairs trader, right, I'm going to be long Apple and Tesla and short these names that have no future, right? So that's also the key of like that's gone way out of whack.
Yeah, I mean, look, there's been a lot of talk about factors and what's wrong. Why is quantitative trading not working? Whatever. The reality is they're playing the wrong game. So what's deemed quantitative trading now is based on fundamental factors on issues that have nothing to do with supply and demand, really. And if anything, they're they're counter correlated to it because people are playing that game and it's not the game, so they're getting taken out on it. And so,
So we're probably going to hear some stories about some smart hedge funds that were piling into this alongside the retail.
Yeah,
like,
I mean, yeah, sorry, go ahead.
My two things are like, one, AI-driven funds aren't there yet, right? Because if you have the smart AI, it's identified this 6 months ago and is already put into the trade. So that's neither here nor there. And two, like where are the smart macro traders that are saying, hey, we need to be in these trades. This is what's going on. Or is it worth it? Or maybe they're like, no, even though this has happened, it's such an outlier. It's not worth chasing that kind of outlier. It's going to happen once every 30 years or something.
No,
there just aren't enough funds out there that have completely switched to the fundamentals don't matter. It's all about who's buying and who's selling. I mean, a lot of guys do that, but that, there's so much money out there playing the long short value game, right? And it's just those guys they're at a huge disadvantage, and there's a lot of money that's going to continue to, unless they start looking at where the supply and demand is, that's going to keep preying on it.
This is exactly. Sorry to cut you off, Jeff. I'm cutting you off today, man. I apologize. No, this Cem, you hit on that perfectly. I'm so outspoken on social media about these things, and also in some of the other interviews that I've done. But this is why I don't believe fully quantitative models, especially in the vol space, work. You need some sort of discretionary overlay, because there are times like this where the model is going to say, okay, there is a dislocation and upside skew, between these two names, right? Now you're short a calendar and you're getting blown out the water, right? Like if you were short a call on GME, right? Like a week ago, it doesn't matter what strike you were short. It doesn't matter what structure you were short. It does not matter. You are blown out. Even if you were short one lot, right? The thing went from like 15 or something to $350. It does not matter, right? So you need that discretionary overlay. You need to be able to realize what is creating this dislocation from a supply and demand dynamic, spot that, assess it, and then make a trade. If you just have a purely quantitative model in the vol world, right? The model, especially if you're math driven, like, we are, we take pride in that. But on the same accord, we use our discretion as traders to say, hold on now, what is making this dislocation? And if it's supply and demand driven, do we want to get run over? No.
I agree 100% with what you're saying, but I have a semantic difference that I want, distinction I want to make. I think you need to, people who are quantitative traders need to remodel their distributions based on supply, which is basically what you're saying, right? I don't sit here and discretionarily trade as much. I mean, it's harder on it when you're dealing with idiosyncratic names. So to an extent, like it's very hard to model that. But what I try and do is really model that distribution and put it into my quantitative framework, so I can continue to be very quantitative in my approach. But I agree, you have to model that underlying distribution. It is not a normal distribution. It's not a set, distribution that you're used to. It's whatever the supply and demand dynamics dictate that it is.
But to me, it's more like, right, like high frequency trading is essentially supply dynamics on a super short time frame, right? Right, like they're looking at the order book, and that's where they're getting all their information, and they're trading that flow, right? So we're just talking the same flow, but over days and weeks and months. So to me, it's like that should lend itself perfectly to a quantitative approach of modeling that flow. Ignoring what you're saying, Kris. If I model every time a thing goes 3 standard deviations out, if I sell the vol 97.6% of the time, I make money and life's good, right? That ignores that you're going to blow out on that 2.4% of the time, right? So I get that sort of the quant model is not going to work because you're going to discount where the outliers, how frequently they happen. But it seems to me like perfectly set up for a quant model to say, I'm going to plug in all this fundamental flow info and get a model based on that info, right? If Netflix can tell me what movie I want to watch next, someone can surely model that flow.
Yeah, I think he's talking more about quantitative volatility models, right?
Yeah.
Right, especially with trading
with embedded assumptions, right? And I think to his point, I completely agree with him. It's like those embedded assumptions. If they'll kill you. You gotta have other quantitative models, like you're saying, Jeff, that help you better model what actually is reality in real time.
So how does this all end?
Cem, you first.
Right, like to me, right, it's like the The Hunt for Red October, one of my favorite books / movies, where they like do they turn back into the missile and it breaks up before it has time to arm, right? And he's like, oh, that's it? That's all we got to do? He's like, no, he's changing the settings on his torpedo right now. So like, it seemed to me like, oh, this is it. You just got to look at the most shorted names and buy way out of the money calls. Piece of cake. But for sure, someone's readjusting the torpedoes right now.
Yeah. So this is, we talked about this off air before we got started here, but I think you have to step back for a second and ask yourself, okay, what's actually going on here? Why is this happening now? And the reality is it's because of people are A, at home. B, there's massive fiscal, we've had now 3 fiscal stimulus flow into, and it hasn't just gone to the bottom, right? If it just went to the very, very bottom, you'd have just price inflation because those people aren't really investing. But this is going to lower middle class, upper middle class. A lot of this PPP money went to doctors, lawyers, dentists, right? Small business owners, and those people are at home. Markets are liquid. There are opportunities to make money, and people are taking it. And so that fiscal wave would be expected, is leading to inflation, but not just price inflation, right? It's leading to asset inflation, but not the old kind that you'd expect with institutions and corporations as much as retail, people at home, leveraging their brokerage accounts. And you pair that with, Robin Hoods of the world and all the embedded leverage now that we talked about, as well as better understanding, social media, we talk about on Twitter. Kris and I are out there educating people all the time. People get a better understanding of how these things work and what they can take advantage of. And,
right. Maybe you guys should take all the credit of like, hey, you shouldn't just be out there dumbly
this is Kris's fault,
selling
really.
ball. Like, no, be on the long ball side.
Cem has the big following. This is all you, man.
No, but look, it's this makes sense. So how does it end? So if that's what's happening, how does it end? It ends with people going back outside and spending as opposed to sitting in front of their terminals trading all the time. It ends with retail having to pay some taxes on this potentially in March and April. It ends with anything that's going to limit the flow of capital from the retail that's throwing money hand over fist into it. Either that or, a market correction where these guys get washed out. Until that happens, expect this to get bigger, worse, crazier.
If I'm them, I'm like,
possible thing is if the SEC or somebody comes in and makes some type of a directive that also stymies it. But I think, even that, like, there's a lot of people with a lot of money sitting at home now, playing markets, and they're going to keep trying to find ways to make money, unless that, they're not sitting at home, they don't have that fiscal money flowing into their pockets. You're going to keep seeing this type of action.
Scott Galloway, I like to follow him. He was like, it's all about sex. These people are locked in their houses. They're not having enough sex. They've got all this extra money. They're replacing sex with gambling on college.
There might be something to that. Everybody expected there to be a baby boom. It's actually the opposite.
It's the call option boom, right?
Yeah, not the baby. You're getting too much of each other. I don't want to see you anymore.
And also you said there's a market correction, they blow out, but they might say, I'm using they very loosely of this whole group, like, no, we're buying options, right? How are we going to blow out? Like, we have to lose many, many, many times in a row. I'd counter to that of like, well, when you bought your whole net worth, 50,000 worth on, 200% out of the money weekly calls, like if you do that 10 times, you're probably not going to.
And this is gambling at the end of the day.
Yeah.
You can take half of it out, put in your pocket. I'm never going to spend this again. But the question is, are these guys going to pull that money out of their pocket when the market's down? I'd wager.
Right. So it's less a correction, right, than just it. How many times can you do it before it doesn't work?
This is what makes it super interesting too, right? Is because these guys are winning on all these trades, so the buying power is exponentially increasing as we go along too. Right? They're not losing, like they're winning. They could take that money and now, theoretically just run it back. And that's what's been happening, right? You've had this amazing reflexive dynamic of not only from the hedging standpoint, the short interest, not only that, but when you're making money and, you have not been burned, you're just going to go with the crazy, far out the money call or, just hold the position. And these guys are holding too. You look at the way how some of these things are trading. It does, like AMC offered twice in the last 3 days, 2 big offerings, did not budget, right? Maybe dropped it like, a few percent right back up. So, I think,
the one time is up like 20 million on the April calls for GameStop. Nope, holding. I'm like, what? A lot could happen before April. Look what happened in 1 week, and you want to hold it 3 more months.
Right.
This is where you see like looking at fundamentals is a disadvantage, right? If you're in any way looking at fundamentals, like you would have sold 250, 300% ago, right? But, and that's the other thing, these guys that are, like hedge funds that are short, like you can lose more than 100% if you're short. You can lose 200, 300, 400, 500%. And that's the problem with, being on the short side in this type of a world, especially not on any flow analysis on fundamental. Like,
I don't know. Does anyone know how that works can you sell options on Robinhood naked? I don't even know.
I believe I have a friend that was doing that previously, not now, and I think he was able to. I don't know if they changed this, but this was like 5 months ago. He was selling naked on Robinhood.
Yeah, my two questions are: one, can you sell? And then in their platform, does it like try and auto liquidate you, right? Like, can you go?
Oh, that I know. It does. It definitely does auto liquidate you. Because it happened to him a few times. On very bad positions. He was out faster. Just because they're really tight with their risk, because I think they know that their investor base is very risk focused.
Right, but that's another argument too for the self-fulfilling prophecy, right? Of like the auto liquidation is just going to add more buying power, which adds more upside. So let's talk these big. Cem, you had the comment of like maybe this game's over because these guys are coordinating, of Citadel and Point72 coming in and buying a stake in Melvin.
Yes. So I thought, when the big boys come in, my initial thought was that these guys probably passed this by the SEC before they did it. That would make sense that, if Melvin's having stress that, they'd want that to be stabilized. My general thought was they'd be willing to, not coordinate, but hold these values down. That having been said, I think, I've done a bit of thinking since, genuinely, and the SEC, I think will have a major problem coming out vocally and doing anything, at least too harsh, given the, like you guys have mentioned, kind of the populist rhetoric around this. This has gotten all tied into the inequality narrative, right? At this point, I think, at some point, if it gets bad enough, they'll have to do something, but I could see it going on a bit longer without any SEC kind of.
Right. Well, and it's upside, right? If it was flipped, I feel like everyone would be all over it, right?
Exactly.
Very important point here too. I made this point on Twitter at one point, and I think if at any point, and I don't see this necessarily happening anytime soon, but if this turned, right, and people started realizing you can buy puts and the market's getting really weak and we're going to flip this and start, buying puts and use the same leverage, that's incredibly more powerful than what you're seeing now. It's incredibly more dangerous because the street is short puts, right? At least here, like, the Citadels of the world are getting plenty of call flow in the indices and other places. It's a much more balanced trade to go buy calls. The market also has, as a whole, the market has more limited upside potential, just based on there are embedded longs in the world that at some price will sell. But I do think it's important to kind of at least give lip service to the fact that, if this retail wave could be very, very dangerous if it turns to the downside at any point. And there's nothing that says that it can't or won't happen.
Especially if they're like disenfranchised millennials who want to blow up the system, quote unquote, right? Or like, they're celebrating in the streets because a hedge fund.
And the market gets really weak and they start saying, okay, this looks like this could really go the other way for, may not be as appealing because it's not infinite, right? But you could see situations where this, all of a sudden this adds tremendous, retail's 25% of the flow now. It used to be 5 2 years ago. 25% of the flow all of a sudden turning and buying derivatives on the downside when the street's actually already short. That could be a structurally really dangerous problem. And I know that may sound crazy, but it's a real thing that needs to be looked at and thought about. And so, the SEC has at least got to think about that. Right? If they don't say anything now, are they going to be doing this when the market's down or something? This is happening. So I don't know. There's a lot of underlying questions and things to think about here. This is a brave new world with a new player that it's a little bit crazy, right? They'll do anything. and they're 25% of the market, and that needs to be understood, probably better regulated. Anyway,
Great.
I kind of digressed a bit, but the big boys are definitely going to try and help stabilize things. I do think Ken is I think there are two different situations personally. I don't know for a fact, but I think Stevie's probably more on the side of Melvin at this point. I think Citadel took this as a hedge to their core book and knew that they were getting structural edge in a business that they would have both sides of the trade.
And that's what a lot of people it feels wrong, right? That Citadel can be the hedge fund, the market maker, they've got like all these different somewhat conflicting positions.
Yeah, it's not wrong, it's just smart.
Right.
They're not
Rockefeller.
Anybody really. It's just like they are the system now. They are the infrastructure. Somebody's got to be, and he's bigger, faster, better than everybody else on the street. So.
But how does that end? It feels like at some point that'd be like they're too big, right? They're too big and they're too important to the system to be left to their own devices.
Yeah. I mean,
you're gonna have to prove that. Right?
Yeah, exactly.
That's
like, is it monopolistic? I guess is your question. I don't think yet. Maybe they're really good.
Yeah, but maybe not monopolistic, but just too big to fail.
Oh, they're definitely that, but I think they're also probably too good to fail.
Yeah. Yeah, we got to be careful talking about them here in Chicago. They're going to come put a note on our door of like, hey, stop talking about it.
Right.
So how does this tie into the overall market, Kris, from what you're saying with like your dispersion trades and right, this is the mother of all dispersions?
I wouldn't say there is a sense of dispersion going on. I wouldn't say it's like the mother of all dispersion. It's not your regular vanilla type of dispersion. But I think it's going to impact flows on a big level. Just like what Cem and I were talking about today, right? Relative weakness in the market because of forced liquidation. Apple had nothing to do with this, right? Like the large cap names, SPX had nothing to do with this, but they're going to be impacted because those large funds needed to liquidate, right? So they're going to sell off the large names to make sure that they have their capital. I have no clue as to how this is going to finally end. I do believe that when it ends, it's going to be a big bang one way or the other. This isn't something that's just going to go away into the sunset and it's like, oh, we don't hear about them anymore. Remember those guys? Like, it's going to be something where there's going to be some sort of regulatory intervention, which the more I think about it, I just can't see that happening because, again, imagine the SEC trying to bring these Wall Street bet guys to court. It's, billionaire hedge fund managers versus the little guy. That is that's just a horrible image that, they're going to be portrayed to the media. But, as to what Cem was saying, I do see the other side of it where if the market starts to turn, I think some of these people will start understanding, oh, wait, we could buy puts. Right now, everybody's buying puts when the market is down 20%. Okay, so then what is that going to do? It's going to cause it to be down 50%, right? And then it's tremendously reflexive. From a regulatory standpoint, the SEC has done a lot that has shifted markets. And I spoke about this in another interview, but since the Dodd-Frank Act, right, dealers can't inventory that same amount of risk that they once were able to. Right. So it causes this type of dealer gamma hedging, right? Back in the day, if you had, 100 million worth of Apple and this position is going against you, you could say, hey, I'll take more Apple, right? Like pre 2008, if you were the trader on the desk at a large bank, you ran the show. Now you can't do that. Apple goes against you 10%. You're getting a, tap on the shoulder from compliance to say, hey, what's going on with that position? You now need to hedge it, right? So you create the reflexive dynamic. And that was from the regulatory standpoint, changing the market, right? So what are they going to do now from a regulatory standpoint that says, okay, well, now, dealer hedging impacts the direct flow of the market. Now we need to stop that. So then are you going to allow banks to take massive amount of risk that they did pre-Dodd-Frank? I don't see what direction that this could potentially go. But I just don't think that it's going to end in a, just easy out the door fashion. It's going to be a big ending.
the law of unintended consequences rears its head again.
I think I want to say one thing to Chris's point. I think this is interesting. I think Dodd-Frank has clearly played a role, and the regulatory landscape has made it so there's a bit less liquidity on one side. That said, I don't think this is a supply side issue in the sense that there aren't enough dealers or enough people who are willing to take the other side. There's a little bit of that. I think it's a much more of a demand side issue. I think vol products have grown exponentially. The interest and understanding in them has grown exponentially. And I think it will continue to do so for several major reasons. One, we're becoming a much more quantitatively driven investing world. Everything is factor analysis or some quantitative algo model. And that has itself grown exponentially. And options and derivatives in general are the perfect tool within that framework because they allow you access to the complete distribution of outcomes. A stock is a very poor, investment vehicle in the sense that, it's a linear outcome of a lot of different scenarios and a lot of different information. In a world where you can glean information in real time and try and turn that into profit, you really want to be able to say, okay, this limits the chances of a 20% downside in X stock. I want to go take advantage of that information, right? Not just go, okay, I'm going to go buy the stock or sell the stock. So I think this general understanding has and the flexibility and power of derivatives has entered the broad market, and it's kind of, I've said this to Twitter before, but it's kind of flipped the script where stocks, although they're still the primary investment vehicle, I think there's a long-term trend towards a much more flexible, full distribution of potential outcomes, which lies within the derivatives that these things are priced, that are priced on top of this. In a sense, the derivatives themselves have become the underlying. And
can that
continue? And I think that demand flow, this market is not prepared for. I think that's the problem. You have a structural flow towards something that is incredibly powerful, much better product, but the world hasn't yet adapted to understanding how to manage, and the regulatory framework hasn't been built to provide the liquidity for it. So I think that's actually at the core of what's going on. And I think a crisis of sorts around this will eventually lead to better regulation and better, that'll allow it to grow over time. But right now it's a problem. And the SEC is afraid to come out and say something about this, but it's because they don't have the framework or the tool or the expertise probably in-house to fully come up with a cogent framework to deal with what's secularly changing in this world. And went on a little bit of a tangent there, but I think that's actually what's really driving.
And I like that. But theoretically, can the tail wag the dog, right? Like at some point you get to a point, say there's no actual stock volume and it's all the options, which is never going to happen. But just in that world, how can you price the index, right? Does the index just have to price
parity
at expiration?
You have embedded it within the options chain. You have the underlying. The underlying is a set of two derivatives. Long a call, short a put, the same underlying is the stock value. You don't need a separate stock to price that derivative. You can price it off of its own value.
Right, but that's what I'm saying. Like
it's a framework that people are really uncomfortable with in terms of thinking about it. But there's nothing that says you need to have stock. That's just how things came about. That was the natural cause and origin of valuation, because it was the idea of equity, right, in a business. But in terms of financial market modeling different potential distribution probabilistic realities of an asset, it's a very poor financial asset, and ultimately, the derivatives that have been developed to sit on top of that are much better real picture of reality.
Right, but it's almost like let's just create. We'll just have some random distribution on the computer, and you can put derivatives on top of that and trade those derivatives. Like you disconnect from that, and it's just like you're saying, it blows your mind of like, wait, what do you mean we can trade options without the underlying stuff?
But this is what's happening in the fundamental world, right? You have the ability to take advantage of all these little different things, and it's a much more flexible, much more intelligent kind of framework. And derivatives allow you the flexibility and to take advantage of all those different pieces and to plug directly into the model. So it's an incredibly powerful thing, and for good reason. It's growing in popularity and understanding. And but again, the system is not
And I think we mentioned at the top of like crude oil going negative, that is kind of a leftover of the old analog world and having to settle physical commodities, right? So like it does create problems if you have the underlying has to be settled with the options. Like if that's disconnected, you get a more pure actual price in that case, right? Crude is a perfect example of that.
And we're only talking about the listed option space. We didn't even get into the exotics, right? And the growth of structured products over the last year and a half. Right. So that in itself is a massive beast that is consistently growing in a low rate environment. Right. That is the theme. It's that everybody is trying to hunt for yield, right, as rates remain low. And then the growth of exotic products have skyrocketed tremendously. And now we add the secondary layer of this on. Right. And don't forget.
Give an example of an exotic product.
Oh, you could just go with like a regular like auto callable or let's just say like, you know, a double levered barrier note. So it's like basically the bank is long a way out the money put on like 3-year tenor, 5-year tenor. So you could have like a worst of note, which is like 3 names. So like let's say Apple, Facebook, Amazon. And what it does, the worst of note tracks the worst performer. So if it gets down to, let's say 25% is the barrier, so 75% barrier. If one of those stocks is down 25%, the note gets knocked in, right? So what I'm trying to say is that there are so many other avenues tied to this. And
but real quick, they're selling those to retail. Like
exactly. Yep. Right. They're selling that to retail, right? So synthetically, retail is short of put. Right, that's basically the structure of these things, and they're receiving some sort of a yield,
but with a fixed loss. But yeah, short of put with a fixed loss.
Yeah. So this is the thing I'm trying to say is that as people are reaching for more yield, they're partaking in more of these structured products. That adds another overlay because these exotic traders need to hedge off their book, right? So you have another dynamic of people now having to force liquidate, but this is not from like a retail standpoint. This is a massive institutional standpoint. So you have the listed option stuff, and now you have the exotic stuff, and you could see how this could be a very dangerous game.
And I want to circle back to that of like, how do you know where those flows are when it's kind of off book, right?
Oh man, well we I don't want to talk too much.
Don't give away the secret sauce, but right, if you're a pure flow trader, that seems like an issue, but you guys are saying not necessarily.
Yeah, so I mean that's hard to have a good look from a flow level. You can't get that real time. That's more so like seeing some of the data on stuff that printed at what level. I think you have to track certain structures and certain names. But I don't. It's going to be hard to make a definitive model on something like that right now. But, for us, just having a good understanding as to, some of the names that we track and where's a lot of the Vega positioning at, it gives us some sort of a framework to say, there's.
I was going to say most prime desks actually provide some level of, I mean, Kris can contest this, for their customers, will provide kind of where the biggest gamma points are, the auto callables, where things were struck, and what the general flow is. So you can get some of that from your primes, from your dealers. It's a lot of that's not publicly, but generally passed around.
Trader water cooler talk. Lastly, I wanted to talk like, could this be the death of like the passive thesis, or where do you guys see that of like the whole world's going into target date funds and basically everyone except the people we've talked about is just plowing money into indices, U.S. indices mainly. But does this become, hey, you should be doing more complex stuff, more options? Does this start to lower the power of the passive thesis?
I don't think so. I've talked about this, I think even with you, but Mike Green and I have talked about this. The passive flows are another, just like derivatives are a secular trend because they're better product, right? Passive flows are a secular trend. It's an easier way for people to access the market and do it quickly. And, but the reality is those passive flows are currently tied to growth, right? And that's because of massive liquidity in the system. And, I won't get into all the details, but if there's free money, essentially your companies are best advantage to go for a moonshot where they can dominate the system without making cash flows, right? As opposed to getting current cash flows. So growth names are tied to passive, tied to momentum. In a world where the market declines, they're going to get taken down into passive as well. And ultimately, the value, the thing that performs in a decline, which would generally be a value name or whatever, will eventually develop the momentum to be added into some of the passive vehicles, and will ride a tide higher potentially the next time around. So I think that the passive structure is a real trait of the markets, and will only continue to grow. I believe in that. It's not the only factor, but it will ultimately. I think if you get this handoff of what is in that passive pool, right?
Yeah.
Essentially, all passive is a momentum vehicle. I think momentum is here to stay, but that momentum can change from one area of the value or growth or some factor to another. And I think that's what.
Yes, passive's not going anywhere. I'll be the first to say like that, especially like as a millennial myself, I know straightforward, like passive is not going anywhere. The more some of these millennials become aware to some of the products that are out there, the more enticed they are to say, oh, wow, I want a little bit of Tesla, Facebook, Amazon at the same time, right? And I could be in, some sort of an app that basically takes a percentage of my salary and dumps it into these on a consistent basis. So passive from a millennial standpoint, right? You do have some stock pickers that are coming out the woodworks with this Wall Street bet dynamic and some of the other stuff. But the accessibility towards investing and the framework to it is so easy right now that passive will just continue to grow. And, a lot of millennials that I know, like naturally, they just want things easy, right? Like That's why, all right, fast food, gym, whatever, like everything's easy and fast. Just give me really easy and fast.
Let me click on my phone and give it to me.
Right, exactly, right. And it's the same thing with the investing thing, right? Not a lot of people want to take the time and say, oh, I want to look into this company, let me figure it out. It's just like, oh yeah, I heard a friend that said Tesla's a good stock, I want to buy it. Okay, so by the way, this thing could put you in that buys Tesla, Amazon, Facebook, the best names, right? The best names, they call it. So it's just, from a behavioral finance perspective, I cannot see that this passive flow going away anytime soon. And especially because you look at the fact that the buying power of the economy is now shifting into the hands of the millennials, right? So millennials are inheriting money that their boomer parents had set aside for them, right? They are also becoming professionals in their field, right? So you have millennials who are now accredited lawyers, traders, right? People own businesses. So the buying power is in their hands. What'd you say?
Dentists.
Yes, exactly. So the buying power is in their hands right now. It's slowly transitioning, and the way how some of the millennials think is more focused around risk, right? We're thinking in an innovative type of way where we want growth. Like we want to be in things where I want it to grow, right? I want to make 600-700% on something, right? I want to be in something that's innovative and cool, right? So
but that's almost to my point of like, in theory, you're only going to get 5-6% on these, right? If you buy passive in the index. So maybe they're going to be like, this isn't enough. I need to go over to the Wall Street Bets crowd.
Well,
which was 1.8 million in that chat, in that whatever you call it, in the Reddit 3 weeks ago. Now it's at 3 something, right? What if that's at 30 million or 300 million, right? Like how big can that get?
Well, look at the ARC names, right?
Yeah.
Look at how popular the ARC names have been, right? That's like a millennial type of product in my eyes, at least, right? That is a way that you could have some sort of passive flows into those type of products and be super speculative. So I completely agree with Cem, and I know Mike has been behind this theme for a long time too, and I just can't see it going anywhere.
All right, we'll see. Yeah, I agree, but I want to see like, okay, there's 30 million people on Wall Street Bets. Like, what are you doing, you idiot, of making 5% a year over there? You can make 500 over here.
I think the distinction is important, that passive does not mean growth, right? These names have gotten so stretched. We're at the end of kind of this. At some point, the passive flows reach a point where things get so out of whack that it leads to, something where things fall apart, and there's a period of underperformance of those because there's forced liquidations in all of those same vehicles that everybody was long. And then eventually the thing that outperforms, that becomes a bigger part of the index, then will lead higher. I think it's important to not lose sight of the Fed's role, liquidity's role in all of this, to emphasizing, and reinforcing the value of growth. And I think in a fiscal dominated world or something where value becomes more, cash flow becomes more important because money's not free, I think the passive might latch on to a totally different product.
Money is free, right? But let's
right now you don't need cash flow.
But let's talk about that real quick of just your guys' views on what does that look like? Right, is that how this ends? Is that where the music ends of the liquidity, Fed provided liquidity dries up? I know, Jim, we've talked like they're out of bullets already, but now we've moved into fiscal. So
yeah, it's not necessarily that they're out of bullets. They're up against
they can manufacture bullets.
They're up against people, right? Like politics matters, people matter. If you're in a world where it wasn't about human beings and you were just maximizing for GDP growth, they keep doing what they were doing. What they're doing has created it's accelerated technologies. It's led to a bit of an industrial revolution, right? Corporations are doing better than ever, right? Problem is it's tearing apart at the fabric of society. Inequality is a problem. It's become on everybody's lips, right? It's been a building kind of zeitgeist, and it's here front and center. Everybody's talking about it, has been for years now.
But it doesn't seem the Fed cares about it. They're not giving any lip service.
That's not true. They're actually very clearly coming out and making commentary. Both the Fed and the Treasury in lockstep here, making very clear commentary about wanting to shift to fiscal, about wanting to help underprivileged groups, about getting the money to the people who need it. And if you watch Powell's presser today, 75% of that was
right. I meant more. Is it just lip service, or do you think it's real?
No, I really don't think so. I mean, Janet Yellen's first tweet, her next 5 tweets were all about reducing this gap. She's tied into the administration who has made this the new administration, which has made this their point. And Powell's been very clear about the transition to fiscal being time for a transition to fiscal. And he's been beating that, for about a year now. And that's why they're willing to take inflation. They set the inflation expectations higher. I think they want inflation of 2-3+%, 3-4% is what they're looking for at this point. And they want to reduce inequality. Again, we'll see, right? I mean, nobody believes it now because after about 20 years, everybody's shaking their head saying, recency bias is like, how can that ever happen, right? It's a different.
And can they do both, right? Like that's the big question. Can they improve the inequality by not just hammering the 1% down, but by bringing everyone else up, right? That's the idea of
demand side economics as opposed to supply side, right? And look, that's going to hit we're no longer going to be maximizing for GDP. We're going to be maximizing for median income, which are very different things.
But wouldn't that come down to the individual stock level in theory of like each?
Absolutely. This is everything. I mean,
they're not going to maximize for capital, right?
Yeah. When we talk about flows, Kris and I get talking about like the flow flowing, into what product and passive flows and option flows and whatever. All of that is coming out of one really big pipe. And that's out of, government, that's out of the Federal Reserve and the Treasury, right? And one way or another, that's how it gets to all these places, right? And they're taking that big pipe, they'll just point over here and they're going, whoop, it's going to change everything. And that's what we're seeing. I mean, what you're seeing, to back to our original point, what you're seeing with retail is a direct,
of that pipe just moving a little bit. Right.
Going into a different place is a major driver of what's going on right now. It's going to change a lot of things.
Right, because how much of that pipe was there? What was the amount? 2 trillion, or what was the first stimulus amount?
The first one was 1.1 or 1.2. The second one was 900, and now we're in talks of 1.1 to 1.7. So, right. I mean, that's, people lose sight of how much money that is. The New Deal in real terms was something like $600 billion. Now, economy was the economy was much smaller, right? So you have to kind of relative to the size of the economy. The economy was a lot bigger, but we just had all combined, all three of these will be 3 whatever trillion. And if you think that's the end of it, like, no way.
No way. Well, which we've talked about. To me, this is just going to get people on the basic income trail of like, maybe they don't call it that, but there's like the annual stimulus or something, right? Of just like, no, what are you doing? Look at this is great for the economy. Everything's going up. You got to keep giving these people money. Look,
Yeah, it's
look what
crazy
it
to think
does.
that, 10 years ago, 11 years ago, 2010, fiscal conservatism, like the Tea Party was kind of, it seems like millennia ago. Now it's, we're in a UBI world where, there is no real cost to this. And,
Right.
in the short term as the, dominant currency, as a reserve
And then you
currency.
buy some Bitcoin as your hedge in case it all blows up, right?
Right.
That's a topic for another day. Cool. We'll wrap up. Kris, you got any other last thoughts?
I think, we covered a lot today. I think we touched on a ton of topics, but I think right now this is a rates game. Right, and I think it's going to be very interesting to see how the Fed reacts when it's time to actually really raise rates, and it's going to be really interesting to see what the sentiment on the street will be like when they actually do. Could it be reflexive where everybody immediately says, oh my God, they're finally raising rates, I'm buying downside puts, and here comes some of this flow positioning that me and Cem always talk about, where people are reaching for puts, and then that cascades a 10% move down to like 25 or 30% move. That I'm not too sure. I'm honestly not too sure on. One thing that I do know, in my years of trading, is that when things get one-sided, it is always better to take the other side of the trade. And right now, seeing this dynamic of this huge new participant engage
Except
in
in GameStop.
Yeah. Well, we haven't fully seen how this soap opera is going to play out, right? So we still have to see the full scope of it. But I think this whole dynamic that's going on, I think it could continue for a longer time period than people are giving credence to. I think maybe we could see 6 months of just this constant price action. But I do know when it goes away, it's going to go away hard, whether it's people losing a ton of money and, the market, tanking on something like this, or, some sort of regulatory intervention that's impacting the actual microstructure. I don't think that this is something that's just going to go off into the sunset and just be very quiet. So I think people should be focused on their book. I think they should be focused on, risk parameters in their book and, their true risk, right? Not their VAR that says, oh, that's where your risk is at, and then AMC goes 100% and you're down 90%.
Won't the dealers start pushing the option prices out if they haven't already? I feel like they just have to keep.
Well, yeah, look at AMC. AMC at the money 1 week out was trading at 1,000 vol. AMC, the 1 week at the money was trading at 1,000. Like, what do you want to price it to?
There's no way to price it. It's impossible to widen it enough.
But people were still buying.
It's just not a market anymore.
Exactly. People were still and that's what I'm saying. Like at this point, the vols are irrelevant. It does not matter, right? Tell me the difference between 1,000 vol and an 800 vol, right? Or 1,000 vol and a 5,000 vol. It's the same thing. Yeah. So yeah, it's.
What does that look like? That's like 100% out of the money or something, or 200%, and they're trading for $20 or something, or who knows? It's specific to each stock, but right, it's something insane, right?
Yeah, I can't tell you what the implied move is off the top of my head, but yeah, it is insane.
Right, and the traders are looking at it like, well, whatever, I lose $20. Who cares? Cool. Cem, any other last thoughts?
I've got a lot of them, but what I would say is the way this probably ends is in a decline in the market at some point. I think to Kris's point, I think we could get a lot more of this for a while, and it could get very kind of 2000s on steroids, right?
And a lot more, that means more GameStops, more AMC.
More upside broadly to the market, more, the crazier some of those names get, and the more they get that way, the more likely people are to buy the index and try and sell them, and it becomes a much bigger game, right? That eventually unravels. I think you pair these goings on with, what will eventually be higher rates on the back of it, right? If everything starts appreciating, assets, we reopen, stocks are doing well, they have lots more money, no more distressed assets, right? You got to get higher rates. And so the higher rates are ultimately what kill these things. And, that's how this thing ends. It's not new. It'll be different this time. And its veracity to the upside because of the derivatives. It'll probably be just even worse on the downside because of the leverage and the amount of overextension that we're experiencing. I will say that, this long run and all this, financialization that's been accelerated by really, free money for all this time is going to ultimately end with the shift to fiscal, with a monetary policy driven economy. You lead to deflation and you can do an infinite amount of it. As long as I keep giving all my money to the top 0.01%, it doesn't lead to price inflation. You can keep rates low and you can create new technologies and new, deflationary mechanisms, globalization, but the second this gets to everybody's hands and everybody starts buying stuff and you go to a demand side economics, if you worry about inequality at all, you can't keep doing monetary policy infinitely. The Fed has to worry about inflation. It's the one thing that puts them in the box. And so that's how this ends with higher rates.
Which to me is why they'll never raise rates materially. But yeah,
I think if inflation goes to 6%, they have to, 5%, they have to. It's part of their directive. And so dealing with inequality will lead to inflation, which will put the Fed in the box. It's the only thing that ever does. Higher rates will be the end to this run.
In the penalty box, which box are they getting put into?
Jail cell, whatever. They can't do it anymore. They're penalty box.
Only one way out, right?
Yeah.
All right, guys, awesome. This has been fun. We'll put where to get a hold of you, although everyone knows already, in their show notes. And then be sure to check out, we've done a previous pod with Cem on Aegea. We got one coming up with Kris to dig in what he's doing at Ambrose Group. But he's so good on these little one-offs that we keep having him on before we get to his full stuff. But I appreciate it. I think we're sending some snow your way, Kris. We just got dumped on here in Chicago, so good luck.
Oh, man, I didn't even know that, really?
Yeah, what we have, like 4 or 5 inches maybe?
4 or 5 inches. I got my son out shoveling for me for the first time.
Oh, that's nothing for you guys. You guys are used to like 5 feet of snow.
No, we don't get that. I was just telling someone that the other day, Cem. I'm like, I'm old enough now where I can send my son out to shovel. It's great. It makes me sad, but it's also great.
I'm feeling the inflation at home. I had to pay him $15.
Oh, I don't tell mine that. I just told him that's his job. He's got to get out there and do it. Yeah. Cool. Thank you, guys.
Thanks for having us, Jeff. Appreciate
it.
We'll talk soon.
Take care.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlt and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.